Rental properties have tax advantages. That's what everybody says. But here's the problem. Most investors hear that and immediately assume real estate is some kind of tax-free income machine. It's not. And if you don't understand how these tax benefits actually work, you're going to make bad decisions, you're going to overpay for deals, and you're probably going to leave a bunch of money on the table. Today, I'm going to walk you through the real tax advantages of rental properties and how they actually work and how to use them the right way. I'm not a CPA, so this isn't tax advice, okay? It's just information based on what I know as an investor. No fluff, no TikTok tax hacks, just real strategy. If you hit a screw with a hammer, that's on you. Like the video, subscribe to the channel, hit the notification bell so you don't miss the next practical real estate training built for serious operators. If you're new to the channel, I'm Bud Evans. I spent 35 years in the United States Air Force, 13 years as a police officer, also served formerly as the mayor of Centermints in New Jersey. Today, I'm an active real estate investor focused on single-family and small commercial multifamily properties. I help veterans and pretty much anybody else who wants to get into real estate increase their portfolios. And I founded a low-cost property management company built by investors for investors in New Jersey. So let's get into it. Most investors believe this. Real estate gives you tax-free income. That belief is not correct. Here's what actually happens. You buy a rental property, you collect the rent. You think the profit is yours. It's not. When tax season hits, you'll realize the IRS doesn't care about your mortgage payment. They care about what your taxable income is. And that's where most investors get blindsided, because what you think is profit and what the IRS sees as income are two completely different numbers. And that is the problem. And if you don't understand that gap, you're either going to overpay in taxes or worse. You're going to make investment decisions based on bad assumptions. Here's the turning point. Rental properties are not tax-free. They're tax advantaged. There's a huge difference. So let me walk you through something that actually works. Here's the first concept. Depreciation. This is the one that changes everything. The IRS allows you to depreciate the structure of your property over time, not the land, just the building. For residential properties, that's over 27.5 years. What that means in simple terms is this. The IRS will let you write off a portion of the property value every year as an expense, even though nothing physically left your bank account. So let me make this real for you. Let's say you buy a property for $300,000. Let's say $240,000 of it is the value of the structure. You divide that over 27 and a half years. That gives you roughly $8,700 per year to write off in depreciation. That is an on-paper loss. Now, here's where it matters. If your property produces $10,000 that year in cash flow, that $8,700 offsets it. So your taxable income is only about $1,300. That is how investors reduce taxes. Not eliminate them, reduce them. Here's the second concept. Expense write-offs. This is where disciplined operators win. You can deduct property management services, maintenance, repairs, insurance, property taxes, utilities if you pay them, travel related to managing the property, even software and systems that are tied to your business. This is where your operational discipline matters. If you're sloppy with your documents and tracking of expenses, you will overpay in taxes. It's as simple as that. And based on how you operate, you're wired to be systematic and precise with this stuff. And that's a strength. So use it, because the IRS rewards documentation, not your intent. Here's a third concept. Mortgage interest. Most of your payment early on this is interest. That interest is deductible, not the full payment, just the interest portion. This is another area where new investors get confused. They think the whole mortgage is a write-off. It's not, but the interest still provides a significant reduction in taxable income, especially in the early years of your loan. Here's the fourth concept. Cost segregation. This is a little bit more advanced, but you need to understand it. So instead of depreciating everything over 27 and a half years, you can get a cost segregation study which breaks the property down into its components. Appliances, flooring, fixtures, and some of those can be depreciated over 5 or 7 or 15 years using advanced depreciation, which accelerates your deductions, meaning you take more tax benefit up front. This is powerful, but it needs to be done correctly. Bad execution here will get you audited. All right, here's the fifth concept. A 1031 exchange. This is how you scale without getting crushed by taxes. When you sell a property, Normally, you owe capital gains tax, but with a 1031 exchange, you defer those taxes by rolling the proceeds into another investment property. You are not avoiding taxes. You are delaying them. And that allows your capital to keep working for you. That is how portfolios are actually grown. Now, let's address this conflict directly. Here's where investors will mess this up. They're going to hear about tax benefits, and then they chase bad deals just because of the write-offs. So let me straighten this out for you. Tax benefits do not automatically make a bad deal good. If the deal doesn't cash flow, if the numbers don't work, if the asset is weak, no amount of depreciation will save you. I've seen investors lose money chasing tax deals. That's backwards thinking. You make money on the deal before you buy it. Then you optimize your taxes, not the other way around. And that's how you come back. When you understand this correctly, let me tell you what happens. You buy a solid cash flowing property. You track your expenses properly. You apply depreciation strategically. And then you keep more of what you earn. That's it. That's the game. Not avoiding taxes, controlling them. Play by the rules. Now, a quick pause here. If you're a veteran and you're trying to figure out how to structure your investments correctly, especially when it comes to taxes and long-term wealth building, this is exactly what we break down inside the War Room with David Perret. Real numbers, real deals, real strategy. And if you're not a veteran, when you need it, I also do one-off coaching through buddevans.com to help you build the right structure based on your situation. So let's finish this out with a checklist, like we always do. Understand the difference between cash flow and taxable income. Use depreciation to reduce that taxable income, not eliminate reality. Track every legitimate expense with discipline and documentation. Know that only mortgage interest is deductible, not the full payment. Use cost segregation carefully and only when it makes sense. Leverage 1031 exchanges to defer your taxes and scale your portfolio. Never chase tax benefits at the expense of deal quality, and then focus on buying strong assets first, and then optimize your taxes second. When you get this right, you don't just make money, you get to keep it. Hey, if this helped you, do me a favor, like the video, subscribe to the channel, hit that notification bell, and share this with your friends, if you have any. Thanks for watching. I'm Bud Evans. Aim high, execute fast. See you on the next one.